Many UK directors structure their businesses to shield valuable assets from operational risk. A common approach involves moving the business premises into a distinct, separate property company. The property company then leases the building back to the primary trading company. To ensure everything is compliant, the director is careful to charge a strict commercial market rent. Assuming the property company generates a modest annual profit of around £45,000, the director naturally expects to pay the standard 19% small profits rate on those earnings. Instead of the 19% rate, HMRC applies a flat 25% tax rate on every single pound of profit, with zero marginal relief available. Welcome to the channel. We are Pro Tax Accountant, a UK firm specializing in advanced corporate tax planning and compliance for business owners. When the UK reintroduced the dual-rate corporate tax system in April 2023, it reactivated a long-standing piece of legislation regarding close investment holding companies, commonly known as CIHCs. By setting up what appears to be a standard, prudent risk management structure, thousands of SMEs are inadvertently triggering the specific tax classification. The baseline 2026 corporate tax system operates in 3 tiers: a 19% small profits rate for profits under £50,000, a 26.5% marginal rate between £50,000 and £250,000, and the 25% main rate for profits above that limit. The CIHC classification completely bypasses those lower tiers. If labeled a CIHC, a business is taxed at the 25% main rate from £0. For a standard trading company earning £45,000 in profit, the tax bill at the 19% rate comes to exactly £8,550. But a close investment holding company generating that exact same £45,000 in profit faces a tax bill of £11,250. This results in a £2,700 tax increase every single year, applied because the company falls into a specific statutory definition. CIHC status operates as an absolute disqualification from small business tax relief, rendering the actual size of the company's profit irrelevant to the rate calculation. To determine if a company is subject to this rate, we must apply the 2-step statutory test outlined in Section 18N of the Corporation Tax Act 2010. The first step is establishing whether the entity meets the legal definition of a close company. Under UK tax law, a company is considered close if it is controlled by 5 or fewer participators, meaning shareholders, or if it is controlled by any number of directors. Most owner-managed businesses, private family enterprises, and contractor-limited companies meet this definition by default. If you own and operate a small private business in the UK, the company has likely already met this first set of criteria. The second part of the Section 18N test defines CIHCs through a principle of negative presumption. By default, the law presumes that a close company is a CIHC. To avoid the classification, the company must prove that it exists wholly or mainly for a permitted purpose throughout the entire accounting period. Because the legislation is drafted negatively, the statute defines a CIHC by what it is not, rather than what it is. The primary permitted purposes that allow a company to escape CIHC status are carrying out a commercial trade on a commercial basis or investing in land for commercial property letting. The burden of proof sits on the business to demonstrate an active commercial purpose to avoid the 25% rate. This structure highlights Section 18N's rules for commercial property letting. Letting to a connected person, including sister companies under common control, or relatives, disqualifies the activity. Even if charging strict market rent, the law deems the letting non-commercial, classifying the property entity as a CIHC. This rule applies to commercial warehouses, factories, and office blocks just as strictly as residential dwellings. Separating physical assets into a sister company to protect them from operational training risks transitions that holding entity into a passive CIHC for tax purposes. This restriction extends beyond property. It directly impacts family investment companies and entities holding passive share portfolios. Family investment companies typically exist to hold passive investments. Lacking a permitted commercial trade, they are almost universally classified as CIHCs. If a business attempts to transition from an investment holding profile back into a trading company, it must demonstrate substantive physical economic activity. HMRC and the tax tribunals have confirmed that changing corporate intention in board minutes is insufficient. Escaping the classification requires a shift in actual operations. passive corporate wealth building, regardless of the specific corporate vehicle used, is subject to the 25% corporate tax rate. It is possible to resolve the connected party property issue while still maintaining necessary asset protection. The solution is found in the holding company exception in Section 18N, subsection 2, paragraph C. The structure moves from a horizontal to a vertical alignment. This vertical alignment is typically achieved through a share-for-share exchange. The inserted holding company can be excluded from CIHC status because its primary purpose is holding shares in qualifying trading and property subsidiaries. Executing a vertical restructuring allows a group to restore tax efficiency while maintaining the operational risk barriers between assets and trade. Operating passive investment vehicles, holding substantial retained profits, or leasing property between your own companies can trigger the 25% CIHC rate. This video is for educational purposes only and does not constitute formal tax or legal advice. UK tax law is complex and subject to change. Implementing a corporate restructuring strategy requires advanced tax clearance from HMRC to ensure the transaction does not trigger immediate capital gains or stamp duty liabilities. If your business is impacted by CIHC rules, contact Pro Tax Accountant for professional, bespoke advice. You can reach us at 07985 689 912, email us at info@protaxaccountant.co.uk, or visit www.protaxaccountant.co.uk. Please subscribe to the Pro Tax Accountant channel for more updates on UK corporate tax strategy. We recommend proactive management of your corporate structure to ensure the long-term efficiency of your business.